Welcome back, everyone, to another episode of Let's Talk Housing. If you haven't tuned in before, my name is Brennan Thomas. I am the co-host here alongside Stephen Thomas, the chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and updates. As usual, we'll talk about fallen rates, sidelined buyers, cash buyers, and potential fixes to the supply problem. So, Stephen, I think there may be some big news in the family for the Big Thomas household from what I've heard and seen myself. Would you mind telling us that news?
Well, yesterday morning at exactly 7:53 a.m., weighing in at an incredible 7 pounds, 11 ounces, our granddaughter from Michaela and Sean Schwietert, our daughter, had a baby girl named Rowan. So Rowan Schwietert decided to come and enter the world at exactly 7:53 a.m. Not that we're keeping track of the statistics, and did I mention 7 pounds, 11 ounces, and so cute. We went there yesterday after of course she's going to be born, and I found out right during the start of a presentation that I was doing, and I got all choked up and got all teary-eyed, and this whole entire office, everybody's eyes were staring at me as they were doing their pre-meeting announcements, and I was trying to compose myself as best as possible. So this is true, happened. I was absolutely ecstatic, elated inside that finally our little baby granddaughter had been born. And for those of you that are wondering what I'm going to be called, it's going to be Pop-Pops, not Grandpa, because I have a 5.5-year-old Zeke that's running around who said, I don't want to be an uncle. And I said, well, to make it a little less confusing, when we have a 7-year-old and a 2-year-old running around, and one's calling me dad and the other one's calling me grandpa, we'll just have one call me Pop-Pop. And I think that's going to be really cute when it comes from a little 2-year-old girl. So we got a hold her yesterday, and I'm telling you, so pretty, so beautiful, so light, smells good, that baby newborn smell, and we were absolutely in love, and just so happy for Sean and Michaela. And I think that was yesterday. What happened today, Brennan?
Yeah, thankfully I got to go see her and I got to hold her, and she was just the sweetest, most cutest bundle of joy I have ever held in my life. It's just so tiny. It's hard to imagine someone being that small, and I know I've seen Zeke that small. I've seen Mason and some of my other siblings, and it's unbelievable every single time, and it just blew my breath away how cute and adorable she was. It was amazing. But yes, so let's get into it. Steven, I also heard that we released a brand new county. What county is it, and what is happening there?
So the county that we are unleashing is Ventura. Now we've covered all of SoCal, and Ventura was in between Santa Barbara and Los Angeles, and there's certain areas like Ojai that they're going to say we're not part of LA, we're more of like Santa Barbara, which I totally concur with. But we're at the point where we've had enough agents in Ventura ask us, and brokers, when are you coming into Ventura? There's such a smaller number, but we had enough people that said, come on, can you please come into Ventura? And we've been following the numbers for a very long time. It just made sense just for us to launch it. So we're actually launching the app before we launch Phoenix and Vegas, because that's our next markets to launch. But we're launching in Ventura next week. Super excited about it.
As usual, what is happening in today's market with supply, demand, and expected market time?
Well, the continued mantra. I thought we'd kind of hit a peak, but we're definitely going to hit a peak in the next week. We're almost peaking out, but it's continued to grow a little bit in the markets, as well as demand has continued to come down, which means that the market has continued to slow. Now, normally we peak in California, and specifically SoCal and the Bay Area, between July and August. This year, the peak, even in Orange County, we thought we hit a peak already. I haven't seen the numbers yet, but it's very, very close to where we were back when we peaked in August. So very, very similar. So it's like it's done nothing. It's gone to like flat line. Normally, you hit a peak and you start to come down. It's this normal curve, this hill, looks like a hill. But not this year. We kind of hit that peak or close to the peak in many markets, and it went either flat or continued to go up. In SoCal as a total, it went up. And so the inventory has been growing while demand has been diminishing. And as a result, the market times have been growing longer and longer. I'm not talking about days on market. The speed of the market that we do is expected market time. You place your home on the market when you open escrow. It's more based upon the velocity, the number of homes on the market and how that's changing, and the velocity of the market based upon pending sales. Well, if you have pending sales that's dropping and you have inventory growing, intuitively, it doesn't matter what days on market's doing. You should think if you have more available and there are fewer buyers in the system, the market is slowing. And that's exactly what we're seeing in the numbers. It's kind of the way that everybody's feeling in the marketplace, way different than what we had during the spring. And this is true for all markets. Now, like I said, we're about next week. We're a week out from Thanksgiving. It doesn't matter what the market has been doing. It's going to hit a peak. And after that peak, it's going to come down. There's two reasons for this. We're going into the holiday market. The holiday market's where there are fewer homes. The fewest homes come to the market in December, second fewest in November. And by far, December is so far lower than every other month. There's very few that come on. And right now, with people staying in their homes, where we call that just kicking back in their homes with these low rates, in December, it's going to be even lower than what even was prior to COVID. So you're just going to get this really muted supply push. And then you have a whole bunch of people that just say, you know what, they maybe came out a little bit overzealous, overpriced homeowners as sellers. And as a result, a lot of them pull their homes off the market during the holidays. I'm telling you that we're 1 week out from the holidays next week. It's Thanksgiving's just a couple weeks away. So then as a result, starting next week, you'll see more and more people pull their homes off the market, fewer people coming on, and you'll see this inventory really come down along with demand. And matter of fact, it'll probably outpace demand, and we'll see market times actually ease a little bit, get a little bit better in many, many markets. So that's what to expect for the rest of the year, and that's where we're at right now.
Now, I wanted to start on more of a positive note. Mortgage rates dipped at a pretty steep rate. Last week for us right now, it's November 10th, but when we release it, it'll be 2 weeks. Are there good things that come from this news?
Yeah, it establishes exactly what we have been talking about, and it's also in our forecast for 2024, which we will have on YouTube in the month of December next month. So really, what we're seeing is that there's not a lot of movement as far as money being thrown into stocks and thrown into bonds. Now, they'll throw money towards long-term assets like bonds and mortgage-backed securities, which when bonds go down, so do mortgage-backed securities, like 10-year bonds. So what happened last week is the Fed actually changed their tune a little bit, and they weren't as aggressive as they were in September when they originally said where their predictions are for the short-term rates. So they said for 2024 that we're going to be 0.5% higher than what we thought, and the markets really took that probably the wrong way because the Fed really doesn't know where they're going to be. But anyways, they took it the wrong way, and all of a sudden we saw interest rates and bonds go up. Well, last week the Fed changed their tune a little bit, and then on Friday, one economic report that was huge over like the last week, and that was Jobs Friday. The employment report came out on Friday, and the number of jobs that were added were like half of what they were anticipated to be. And as a result of it being a lot lower, which indicates a bit of a slower economy, there's a lot of money that's being held in cash, not in stocks and bonds. They're holding their money in cash, waiting for there to be a lid because they don't want to get in too early in bonds and fixed assets like that until they know that there's an absolute top to the economy. This is where we were at 5%, and then all of a sudden we get this jobs report. that shows that it's way less than what they originally anticipated. And then all of a sudden, people flooded the 10-year Treasury mortgage-backed securities, and we saw interest rates go down. As a matter of fact, week to week, if you look at what happened with interest rates, they went down the most since November of last year. It was the biggest 1 week drop, which is indicative of exactly what we're talking about. As soon as we hit a patch of more negative news reports, because what we've really received, or if you look at since the end of July until this last Friday, is just a patch of positive news reports. And as soon as we get a patch of negative reports, what do you think is going to happen to mortgage rates? We've already seen it. There's going to be a flood of cash that moves to long-term assets, and we'll start to see the 10-year and mortgage-backed securities start to drop, and as a result, we'll see interest rates drop further. So, and this is definitely to come. There's enough of these headwinds that are hitting us right now that eventually this is going to hit. Our guesstimate is it's for sure going to happen by summer of last year. I say 50% chance by summer of next year. It's going to be, I'm right now starting to lean towards 25% chance in the first quarter of 2024. So that gives you about a 75% chance that it's going to happen by, summer of next year or earlier.
Now, if rates were to fall as we head towards the holiday season, just say a little bit more towards lower sevens, what could that mean for the winter market?
Same thing that we saw last year. So we hit a peak of above 7 in October and in November, and then from there on, we started to see interest rates start to fall, especially in December. When we saw that, what we were looking at was actually there's a seasonality to the number of people that are actually getting loans, but if you look at year-over-year basis, you're going to get a pretty good accurate reading as to where we're at. Well, what happened was we saw from week to week increases. And that's the same thing that we can see that was getting week to week increase in the number of people that are actually shopping for a mortgage, which will roll into the number of buyers that are actually purchasing in the marketplace. So we saw that last year, and this was this push because at the beginning of this year, we actually had a real push of activity at the very beginning because rates were coming down off their tops. Now, remember, we were all the way at 8%. Now we're below 7.5% right now today. And you could see that if we were to continue to go drive down, let's say below 7, and we have a 6 handle on that, on interest rates, you can imagine what's going to happen to start off the year next year. It's going to be just like the start of this year. It will be very robust, matched with very few homes in the market because I told you inventory will go down for the rest of the year, and we'll start off 2024 with very similar, if not in many markets, fewer homes than we started off this year. So you match that together and just put it all together, and you're going to have a pretty crazy beginning of the year. And that looks like it's the way it's starting to line up.
Now, we obviously are seeing a good amount of buyers being sidelined by high interest rates. And there are a lot of articles that I'm seeing right now saying that about 5.5% is the magic number to get them back into the buying market. What rate would you say is solid enough for people to really hop back in? Would you agree with them, or is it something different?
Well, I was saying 5.5% like a year ago. So I agree with them a year ago. Now, flash forward a year later, and I actually don't agree with that. I actually just think it needs a 5 handle. Like once we get below 6 and it says something in the 5, all of a sudden people are going, oh my gosh, thank goodness. Why? Because we had interest rates with an 8 handle. We had it at 8% plus for a while. So you go all the way from 8 and we get all the way into the 5s. 5.99 is where we were in February. And I'm telling you right now, there's a lot of people that are kicking themselves going, man, I wish I would have locked in February 2nd of this year. We were at 5.99%. And that was with no points. You can imagine that if we get back into the 5s right now, there are going to be a lot of people that are going to be extremely excited about, they saw 8, they see 5, they're going to be excited about anything in the 5s. I think that is now the magic number. Anything in the 5s feels a lot better than something in the 8s.
The Federal Reserve's aggressive interest rate hikes could be about to trigger a housing market recession that echoes the slowdown of the 1980s, which is what Wells Fargo has said. Can this truly be the case, or could we see a quick reversal once rates drop?
I'm not going to knock on Wells Fargo, but I've heard it from many different people. I just don't think that this is their lane. Their lane is loans, and I don't think that they're looking at the big picture. I don't think that they see the kind of changes that we do, that there will be a real flight to safety really fast once the economy in the United States slows down just a bit, because what that will translate to is a lot of Wall Street probably not doing as well. To offset that a little bit will be the money that's being parked into safe havens, like the 10-year treasury, long-term assets, and mortgage-backed securities. We'll watch those interest rates fall. So once interest rates fall, we're not looking at the same thing, because really fast, I could show you what happens to affordability when we move from 8 to 7 to the mid sixes. It's a big change. And so they're talking about the 1980s, when we, of course, had interest rates that got all the way up to 18%. It's not exactly the same thing. They're saying that it was a little bit sluggish. It will be off a little bit as far as the number of sales, very similar to the 80s that way, because of the number of because of how high interest rates are. But that can change extremely fast if we have enough of a slowdown in the economy, which we could have, and then we're down into anything with a five handle. And I've already explained, once we get into anything with a five handle, it could be off to the races again. And we could have an extremely hot market, which would not be like the 1980s.
Now, I just wanted to ask, is there a wave at all of price cuts coming as the market cools seasonally and less demand, obviously, with a little bit higher rates? What would you say?
We've already experienced that. Now we're going to experience the opposite. That is there's a lot of articles that are a little bit late to the ball game, and that would be one of them, because now we've already had interest rates come down the fastest in a week. So when you have interest rates come down, it really offsets. And there's people that you can already see it in the mortgage application index. It actually went up week to week. Why? Because we had interest rates drop the fastest in a week. So, and that will translate also to this coming up. Every Wednesday, we get another snapshot from Mortgage Bankers Association (MBA) that tells us exactly what it looks like. And I imagine that this coming up Wednesday, it's going to be more of the same, because we've had rates that have gone from 8 and now we're hovering around 7.5%. But even a week ago, because that takes into consideration, a week ago, it hadn't come down quite to where it's at right now. So we're right at that 7.5 threshold. So even next week, it's going to look a little bit better. So I'm kind of seeing the opposite. And there already are a bunch of reductions in asking prices across the United States. It's actually going to peak out. And from here on out, you're going to get fewer price reductions to the market. Why? Because we're hitting the holiday market, and a bunch of people that have just overpriced and didn't approach it appropriately from the get-go are going to pull their homes off the market, as well as there will be new homes that come on the market. So the percentage is going to dwindle over time. So we've already hit that peak that they're referring to, and that's like old news. Now I got to look at where are we going from here, and that's what I just described.
Now, I do want to touch back on the conversation about the Fed. Recently, Bloomberg did an interview with the Fed President Kashkari, where the interviewer asked Kashkari if he feels that the Fed is responsible for the U.S. housing market after the roller coaster ride of rate movements, and how now a generation is locked out. And Kashkari denied the claim, implying that it's due to not enough sellers and that the Fed was fighting the pandemic and inflation aggressively. What's your opinion on this matter?
Uh, the more I hear Kashkari, the more I'm less of a fan. I liked him early on, but he's sometimes when he talks, you gotta like own what you're responsible for, and everybody's responsible for a little bit of this. Them keeping mortgage rates, not mortgage rates, but let's short-term rate down at 0% for too long was part of the problem. Transitory probably went away. They talked about transitory. Everybody kind of believed it at first because they were talking about it in 2021 at the start. But by the time we got to summer of 2021, that's where it began to wane. It's no longer a transitory issue. This thing seems a little bit more deeper than what you had originally anticipated. And they took a while to pivot. In September of 2021, they thought that they were only going to do 0.25% hike in 2022. That was just a few months before the start of 2022, right? And we know that actually what they did was 7 rate hikes. And rather than go from 0 to 0.25%, they went from 0 to 4.5% in a really for all of 2022. That is a big discrepancy gap. But they came to the realization probably around November is when you started to hear it, and then it showed up in December when they met. By the time they got to December, they should have already been pulling the trigger on short-term rate hikes. And instead, they started announcing it, and they weren't even going to do it in January. They were waiting all the way till March. And then they weren't going to unwind their balance sheet, and they weren't going to start that till the summer or April. And that meant that they were pushing that off too. So all these different things they were tiptoeing around because they were worried what was going to happen to financial markets. And they didn't want another Lehman's Brother issue. But you know what? Sometimes you have to be a little bit more proactive rather than reactive. And unfortunately, the Fed is guilty of being reactive like so many different government agencies. When you're very reactive, as a result, things are going to happen where you waited too long. They waited too long to call off their transitory call. They waited too long to start to make the changes in the short-term rate, as well as bleeding off their balance sheets and closing a whole bunch of windows. They waited too long. So what ended up happening is they did too much really, really quick after that. They shocked the system. But waiting too long meant that a lot of people had the extra several months. And in my argument, it was all the way from when they started talking in June. They should have started to see it by the time they got to summer, July, definitely by August of 2021, and they should have made movements right away. They waited and waited and waited and haggled about it and talked about it, but as a result, more and more people got into the market and rates remained too low for too long, below 3% for a while, then they got to right to 3%. And then we started off 2022 with 3.25%. We would have been talking about 3.25% in the summer of 2021, and this would have cut off a lot more people, and it would have allowed them to work on inflation much sooner, rather than they came late to the inferno. And by coming late to the inferno, they had to put more water on it, which is higher rates, and then they had to remain around for longer, which is what we're currently enduring right now. And this could have all been behind us, and we could have had rates that started to come down and more equilibrium in the market, more transactions to take place on both the buyer's side as well as more sellers that would participate. But instead, they waited too long, which pushes out millennials and first-time home buyers and all that stuff. And yes, they have a bit of responsibility to that. So unfortunately, yes, Monday morning quarterbacking, you can look back and you can own what you did wrong. And unfortunately, they don't talk like that.
Now, many economists are saying that the shock of mortgage rates being as high as they are now will not hit the housing market for years to come. Is there a true lag effect to that, or are we seeing it now as well?
Yeah, is there a lag effect? Repeat that question. I don't quite understand.
Many economists are saying that the shock of mortgage rates being as high as they are now will not hit the housing market for years. Is there a true lag effect to this, or are we seeing it now?
Yeah, there is a lag effect to it. It's also part of my forecast. We talk about the lag effect to it, and yes, it is going to hit the market down the road. That it will hit it. It's not going to hit it to the point where you're going to see values come down. Really, what the lag is on the short term side of what the Federal Reserve is responsible for. And because there's a lot of people that are anticipating that eventually values have to come down because prices are so out of whack and affordability is so out of whack. The problem with that thesis is that so many people are kicking back in their homes with fixed mortgage rates that don't have to go anywhere. So there would be no real push for them to sell. And even if they did have to sell, the inventory remains low, so they can easily be absorbed because they have plenty of equity. So there's no sort of distress in the market going forward looking out. What we really see is all that short-term rate that they changed, the Fed. Now this hits more on the side of like commercial banking, and there is it's over $1 trillion worth of debt from the commercial sector that's going to come due and payable from this year through 2025. An example of this is actually PIMCO out of Newport Beach. I brought it up before, but this is a really good example because the way that commercial loans work is they're not fixed for 30 years and then you own your place. Instead, they're fixed for a duration, certain amount of time, then you have to go out and get a new loan. All these commercial loans have really low rates on them. them. However, once they come due and payable and they have to get a new rate in this environment, they go to banks, the regional banks. They're going to give them a much, much higher rate. And as a result, people are walking away from refinancing their debt because they can't afford the new payment. An example of that was that PIMCO out of Newport Beach. There, they had 10 hotels. They were part of a fund that that owned these 10 hotels, and they walked away from the debt because it didn't pencil out, didn't make sense. And they're one of many that are starting to do this. So then this will happen over time, which just shows you that fuse of rising up interest rates takes a long time to hit a lot of the economy. And this is just one of those examples.
I read some articles indicating that our government is taking more initiative to convert commercial spaces to residential ones. Is this the fix to our long-lasting supply problem?
One of the fixes. They need to look at a lot of things. I've talked about this before, but and we all know my father-in-law, mother-in-law is your pappy and Nana. Their pizza place is right there in Rancho Santa Margarita. There used to be a big strip center. The whole entire thing, they kept all the restaurants in front, bulldozed down the rest of it, and there's mixed use. That's kind of like the wave of the future. That's part of the fix. It's not going to fix the problem here in California. The problem is too vast, too wide. There are other things that they can do. Their portability of mortgage rates is something that needs to gain a little bit more steam. Like, hey, you know what? I've got this low fixed rate. I don't want to move. Hey, wait, you mean I can take my mortgage rate someplace else? Well, then sure, I want to do that. You'll actually get more movement. We have to look at that. We have to look at other parts that will help the supply side. And people are going, why are you working on the supply side? They're the ones with all the money. Because if you want to make more movement and add more supply, you have to fix the supply side. So you have to focus on that. You just can't give everything on the buy side where you have lower rates for affordable income and lower income people. Those are great programs. However, they only address adding more demand to an already deprived inventory side. The more demand makes things even more lopsided. So you have to work on the inventory side. So another one is capital gains exclusion. Right now, couples can exclude on their taxes up to $500,000 and individuals at $250,000 of gain. Let's say you purchased your home at $500,000, it moved to $750,000. You're an individual. Guess what? You can write off all that $250,000 and pocket it all. If you're a couple, you can go from 500 to $1 million. And people are going, well, why do you want to change it? Because that capital gains exclusion of $250,000 and $500,000 was pegged to $1997. And back then, the median sales price of a home across the United States was $140,000. And that was the $250,000 for an individual. What they want to raise it to is $500,000 for an individual, $1 million for a couple. And now you're going to free up more people that won't have the capital gains hit. And you're thinking, well, we don't want to help out them. Well, you do, because you want to add more to the inventory side to incentivize people to move rather than stay in their home, which is what's happening right now, especially baby boomers. They're going to be hit by such a high capital gains that they just don't want to move. But if we incentivize them by saying you can take your capital gains and you don't have to pay it and you can go move someplace else so that these millennials can go purchase your home, that's a win-win. And we're working on the seller side of the equation.
Now, a Chicago City Council committee advanced a measure Tuesday to raise taxes on the sale of properties over $1 million, with their goal being to increase affordability and reduce homelessness. Does this seem like a viable solution?
So this piggybacks off of Los Angeles, which was there first. Let's say the city of LA did it first, and they did it for multi-million-dollar houses. So they're dealing it from the 5 to 10 and the 10 million plus. And you're saying, yeah, those people should be totally hit. Well, here's what's happened as a result. There's a couple things. Number one, there are fewer closed transactions. So now all of a sudden you've taken all these closed transactions and you've diminished the number that there are. And we're actually tracking it right now on a monthly basis. Fewer home sales, not just fewer from year to year because that's natural, but way fewer because of this tax, A. B, you have so you're having fewer tax dollars going in. Now, the tax dollars that they're receiving, guess what? They now have lawsuits, litigation against the city. And the city of Santa Monica is doing it as well. So as a result, they have this litigation that they have to go and fight as well. And they're actually going to net like zero at first. And everybody's thinking, well, you know what? That's okay. We're going to figure it out, and that's what we should do. We should tax the rich. The problem is we're doing it during a time period where we're really starved for inventory in all price ranges. This is not the time to address this. The time to address this and do this down the road when we have a normal housing market with a lot more transactions taking place versus the number of transactions we have taking place. Very similar to Great Recession levels, or in some areas even lower, because people aren't moving. And demand is so low, so you have very few transactions across the board. So let's go ahead and take it to a little bit more deeper and add to fewer transactions. This is not the time and place. So this is, once again, being very reactive to a problem and trying to address it a certain way. But let's be proactive and figure out when is the best timing for something like this if you wanted to go forward. And I'm not being political saying one way or the other what I agree with or what I don't agree with. I'm just saying timing right now is not smart. That's in my own opinion, or as so many kids put, what is it? IMO, in my opinion.
In my humble opinion, yeah.
Oh, yeah, IMHO.
All right. Well, according to CNN, the U.S. housing market affordability plunged to the lowest level since 1984, with expectations of it only getting worse. How long can this potentially last? And is there anything for those of younger generations you'd like to advise?
Well, two things. The appreciation's not continuing to grow from where we're at currently right now. I think we're going to start, because we're still seeing data that's old. So we're still seeing September data. We haven't seen October data and through the home price indices. And it's going to start to slow based upon all the metrics that we're looking at, and we had interest rates cap out at 8%. So they're only going to go down from here. And as they go down further, this story of comparing it to 1984 is going to go away, or it's worse than 1984. Well, yeah, 8% with values at where they're at today. This has nothing to do with more than what the Fed has done. And my argument is the Fed is done. They're actually done. They should actually reduce the short-term rate by 1.5 points right now, today. And they've done what they're supposed to do. But there will be a lot of people, a lot of pushback from me saying something like that. But you know what? At the end of the day, I think the Fed's done too much. And the inflation is doing exactly what it is supposed to do. And then once they're past that, which we will eventually get there no matter what, you keep these interest rates high, guess what? Housing market is already slow. It's not going to slow down anymore. You're going to get the rest of the economy to slow. And when the rest of the economy slows, then eventually we'll get those interest rates that are lower. And at that point, you're going to start to see what happens when you plug in a lower interest rate with incomes that have been slowly but surely rising, about 5% per annum right now. And then you have the values that are remaining the same. With lower interest rates, guess what happens to affordability? It starts to rock down. And that is what's to come. These are all sensationalized headlines. Why? Because they're all about clicks. And we know what's going to happen in the future. They didn't interview me in this article.
On the topic of affordability, it's reported that one would need to make six figures to afford a home in most cities across the country. How severely outpriced would you say some or many Americans are today?
It gets worse the higher the cost area. So LA, Orange County, they're the 50th most unaffordable metro. And then when I was speaking with an audience that was in LA, they go, can't you just say that we're the number one? Okay, you're the number one most unaffordable metro. Rather than if you have a list and you're most affordable down to the 50th, all right, you're number one. But that once again goes hand in hand with where interest rates are. So it gets a lot more affordable really fast once interest rates dive. And when they go from 8% to 7.5%, the unaffordability and affordability, it moves fast the higher the price, as well as going from 7.5 to 7 or 7 to 6, which is where we actually think things can go next year. See, going from 8 to 6, watch what happens to affordability. It really, really changes. And in the higher priced areas, they're higher priced for a reason. They're going to be more unaffordable. They always have been. And they will continue to be even more on the echelon of pushing that unaffordability button because of the inventory issue that we have. And we will continue to have for quite some time. So part of it was COVID making things worse for the inventory issue. Part of it was Dodd-Frank. And the combination of everything all together makes this inventory that I do not see a fix anytime soon. So as a result, these higher unaffordability levels means that there's a certain segment of the local populations within those markets that are so high priced that simply cannot afford the home for right now. And I don't see a short-term fix. We'll have to see over time.
Now, as homes become or have already become unaffordable with high prices and soaring high rates, more and more headlines love to say that housing is cracking when there's a small decline in prices, like month over month. What does a small decrease in prices really indicate? Would you say that it's really a crack? Because to me personally, I would say a crack sounds like it's leading to a break. But what do you have to say?
Not a break. Yeah, and it's just more of the narratives. You have to understand that the way that you see YouTube and you see a lot of articles. I've seen a ton of articles. I'm not going to name the different magazines or outlets across the United States that are national, that they are the absolute best. They used to not be this way, but they are the best at sensationalized headlines that are negative for clicks. And that's just how it works. That's the way that the business works. I did one today. I did a negative headline, which sounds like 2024, there's a crisis, housing crisis to start 2024, and it's not a crisis in where there's going to be the market's going to cave and we're going to have a housing crash or a bubble or foreclosures, that a bunch of foreclosures. The crisis is the number of homes available, which is what I have been saying over and over again. We are actually just about to enter the holiday market. We're going to have fewer homes start off the next year than probably the start of this year in many, many markets. And as a result, that is just unhealthy, and it's very, very, it's at crisis levels. It's a real problem. Now, that's a real problem for the housing market. But unfortunately, all these other outlets, they're really looking for clicks. And the crack that they're talking about, I only talk about cracks when there's a crack. And I saw a crack last year. I talked about cracks. Why? Because we saw cracks really quickly in demand caving and all of a sudden the velocity of the market changing. Those are cracks. We are not seeing cracks in the market right now today. Even if values go down a little bit for the remainder of the year, that's not a giant crack. We had values going down at a way stronger clip last year. And then we saw what happened when inventory drives down so low this year. We had values going up. So let's call a crack what it is. A crack is something that leads to something that's bigger. That's what we like to say, because we like to talk about the truth, not a narrative of trying to get you to read our article and then not address what's the reality of the market. And if that's what these led to, the reality of the market, which is not what they lead to, because after reading it, you're left with the idea of this really could lead to something bigger, and it's just not true.
So, to finish off today's episode, Redfin said that 1 in 3 US homebuyers paid in all cash in September, which is a crazy statistic, the highest share in nearly a decade, with 2014 being the last time it was this high. Can you explain why we are seeing such a statistic like this?
I was having a hard time with the statistic because I was going, yeah, the highest in SoCal was 30%. But you have to understand, things are a lot more expensive here. But across the United States, 1 in 3, that's pretty close to that. You have to understand that, yeah, 1 in 3 sounds like a big number. However, if you look at the true number of all cash across the United States, back prior when we did more transactions in like 2021, it wasn't 1 out of every 3, but we were doing a lot more cash transactions back then. It was probably closer to 22%, but we were doing a lot more back then than we are right now. It's just that right now, cash doesn't care about the higher rates. So cash just still continues to drive the market in a big way. And as a result, if they're continuing to do it, maybe less than 2021, it's still a larger portion of the overall market. So when you're looking at it, it looks like a lot when you say 33%, but the total numbers are way less than 2021, as we know, because the numbers are way down. So it just makes intuitive sense that once interest rates fall, that cash is no longer going to be king like that. We're going to see it go from 33% to less because there are a flood of more borrowers that can actually purchase a home, that can afford to purchase. They'll enter and compete against all cash, and that will be a big difference coming. So this is kind of like a height crescendo, and it will go down as the market continues to improve with lower rates.
All right. Well, thank you, everyone. And thank you, Stephen, for tuning in to another episode of Let's Talk Housing. Now, if you want to learn more about what's going on in today's market, because it's just crazy times we live in, history, you could say, across Southern California or in the Bay Area, and now Ventura, feel free to check out our YouTube or subscribe today to reportsonhousing.com. Please leave us a good review. We'd greatly appreciate it. And if you have any questions at all, feel free to post it to anywhere in our social media, or you can shoot me an email personally at info@reportsonhousing.com. We will see you soon and have a fantastic rest of your day. Thank you.
Thank you.